The crypto market has entered a phase where silence often speaks louder than headlines, and what is unfolding around XRP right now feels less like ordinary price action and more like a structural shift happening beneath the surface. Before diving deep into this, welcome to XRP on Moon, a space where we break down the noise, decode the signals, and focus on what actually matters behind the charts and the hype. Because right now, something unusual is developing in the XRP ecosystem that most retail traders are either ignoring or simply not seeing clearly yet. There is a growing narrative circulating in the background of crypto circles, institutions, and on-chain discussions, something being referred to as the new 1% of XRP. At first glance, it sounds like another exaggerated claim, another internet theory built on speculation. But when you start connecting the behavior of wallets, liquidity movement, exchange flows, and long-term holding patterns, a different picture begins to form. This is not about price predictions or hype cycles. This is about concentration of supply, positioning of capital, and the silent accumulation phase that typically happens before major market expansions. What makes XRP unique in this moment is not just its technology or its use case in cross-border payments, but the way supply is being repositioned. Large holders are not behaving like short-term traders anymore. Instead, there is a visible shift toward long-term custody patterns, reduced exchange inflows, and strategic accumulation zones that suggest confidence rather than speculation. When assets begin to leave exchanges and move into private storage or cold wallets, it often signals something deeper than simple trading behavior. It suggests positioning for something that is not yet priced in. The idea of a new 1% is not about wealth in the traditional sense, but about control of supply. In every financial market, whether it is stocks, commodities, or crypto, the group that controls the tightest portion of circulating supply often holds the strongest influence over price direction during major moves. In XRP's case, the distribution appears to be tightening in certain clusters, while overall market liquidity remains thin compared to historical demand spikes. This imbalance is what creates the conditions for explosive price reactions when demand returns. But here is where it becomes even more interesting. Unlike previous cycles, XRP is now operating in a more mature regulatory and institutional environment. The uncertainty that once surrounded it is gradually being replaced by structured clarity in multiple jurisdictions. This shift does not guarantee immediate price movement, but it changes how large capital views the asset. Institutional participants do not chase hype. They position early, quietly, and with long time horizons. And when you combine that behavior with reduced circulating supply, the conditions for a supply shock begin to form. At the same time, retail sentiment remains divided. Some still view XRP through the lens of past cycles, while others are waiting for external catalysts to confirm direction. But markets rarely move when everyone agrees. The most significant movements often begin when conviction is low, positioning is uneven, and attention is elsewhere. That is exactly the type of environment XRP seems to be sitting in right now. So when people talk about the new 1% of XRP, it is not just a dramatic headline. It is a reference to a deeper transformation in how ownership is being structured within the ecosystem. The question is no longer just about where the price goes next, but who will control the supply when the next major demand wave arrives. What is unfolding beneath XRP's surface is not something that appears suddenly on charts or flashes instantly in breaking news. It develops quietly, almost invisibly, until the impact becomes impossible to ignore. As we move deeper into this discussion, the concept of the new 1% of XRP starts to reveal a more structured reality, one that is tied not to speculation, but to behavior, accumulation patterns, and long-term strategic positioning by major players who operate far away from retail attention. In traditional financial systems, the 1% has always represented those who control a disproportionate share of assets. In crypto, this concept becomes even more powerful because supply is publicly visible, traceable, and measurable in real time. When large XRP wallets begin to consolidate, and when exchange reserves slowly decline over extended periods, it signals a redistribution of power within the ecosystem. This is not about sudden movements. It is about slow, consistent accumulation that changes the balance of available supply over time. What makes the current XRP environment particularly intriguing is the pace at which exchange-held XRP has been fluctuating. While markets may appear calm on the surface, on-chain data often tells a different story. Tokens are being moved away from exchanges and into wallets that show little to no selling activity history. These are not the kind of movements associated with short-term trading. Instead, they resemble long-term positioning strategies where holders are preparing for scenarios that extend far beyond immediate market cycles. This behavior introduces an important psychological layer to the market. When supply becomes concentrated in strong hands, volatility does not disappear. it becomes compressed, and compressed volatility often leads to explosive expansion when pressure is released. This is one of the core mechanics behind major crypto rallies in the past, where long periods of silence were followed by sudden, sharp price discovery phases. At the same time, XRP is also navigating a unique macro environment. The broader crypto market is increasingly influenced by institutional participation, regulatory clarity, and global liquidity conditions. Unlike earlier cycles driven primarily by retail enthusiasm, today's environment is shaped by entities that prioritize structure, compliance, and long-term utility. XRP, with its focus on cross-border payments and financial infrastructure, naturally fits into this evolving narrative, which is why accumulation behavior becomes even more significant in this context. The idea of a new 1% also suggests a shift in identity. It is not just about who holds XRP, but why they hold it. Short-term traders operate on volatility, long-term accumulators operate on conviction. When conviction-based holders begin to dominate supply, market behavior changes fundamentally. Price reactions become less random and more directional once demand eventually enters the system. Another important factor is time. Markets do not reward impatience, especially in phases where accumulation is still ongoing. Many participants misinterpret quiet periods as inactivity, when in reality they are often the most active phases in terms of strategic positioning. The absence of hype does not mean the absence of movement. It often means preparation is underway beneath the surface. As we continue exploring this unfolding narrative, it becomes clear that XRP is not just experiencing another market cycle, it is undergoing a structural transition in ownership dynamics. And in every financial system, when ownership shifts, power eventually follows. The question now is not whether something is happening, but how large the impact will be when this quiet restructuring finally meets renewed market demand. The picture becomes even more layered and complex. What initially looked like simple accumulation or routine market movement now starts to resemble a quiet reorganization of liquidity and ownership that is happening across multiple levels of the ecosystem. The new 1% of XRP is not just a catchy phrase anymore. It begins to represent a real shift in how supply is distributed, held, and strategically positioned for the next major phase of the market. One of the most important things to understand in this stage is that markets do not move purely on emotion or speculation when they reach a certain level of maturity. Instead, they begin to reflect deeper capital behavior, where large participants act with patience and precision rather than urgency. In XRP's case, this behavior becomes visible when we observe the reduction of liquid supply available for immediate trading. As more tokens are moved into long-term holding structures, the tradable float shrinks, even if total supply remains unchanged. This creates a subtle but powerful pressure point in the market structure. At the same time, there is a growing disconnect between surface-level sentiment and underlying positioning. Retail traders often focus on price fluctuations, short-term volatility, and social media narratives, while larger participants operate in a completely different time frame. They are not reacting to daily candles. They are positioning for multi-month or even multi-year outcomes. This divergence in perspective creates what can be described as a silent build-up phase, where the majority of market attention remains distracted while structural changes continue underneath. Another critical factor shaping this environment is the behavior of dormant supply. In many crypto assets, a significant portion of tokens remains inactive for extended periods. When these dormant holdings begin to shift, whether into cold storage, institutional custody, or long-term wallets, it signals a reevaluation of value expectations. In XRP's case, the movement of coins away from exchanges and into non-circulating environments reduces immediate sell pressure. This does not guarantee upward movement, but it changes the conditions required for price discovery when demand eventually returns. What makes this phase particularly interesting is the psychological tension it creates in the market. On one side, there is a sense of stagnation for those focused on short-term action. On the other side, there is a slow but consistent tightening of available supply that is not immediately visible in price charts. This mismatch between perception and structure is often where the most significant market opportunities begin to form. Historically, some of the strongest crypto expansions have emerged after long periods where attention was low but accumulation was high. In addition, XRP's evolving role in global financial infrastructure continues to influence how different participants position themselves. As discussions around cross-border settlement, liquidity efficiency, and institutional blockchain adoption expand, assets with established utility narratives tend to attract strategic interest. This does not mean immediate adoption translates into instant price increases, but it does contribute to long-term confidence among large holders who think in terms of network integration rather than market cycles. The new 1% narrative, when viewed through this lens, becomes less about individuals or specific entities and more about a category of holders who share similar behavior patterns: low turnover, high conviction, and long horizon positioning. These participants effectively become the backbone of supply stability, and when supply stability increases while demand remains dormant, the system enters a compressed state where potential energy builds quietly over time. As this structure continues to develop, one of the most important questions is how long such compression can persist before external catalysts or renewed market attention triggers a shift. Because in every financial system, compression does not last indefinitely. It eventually resolves, either through gradual expansion or sudden repricing, and in XRP's current phase, everything seems to be moving toward a moment where structure, sentiment, and liquidity will eventually collide. The market begins to behave less like a reactive trading environment and more like a carefully tightening system where pressure builds quietly over time. The deeper we go into the idea of the new 1% of XRP, the more it becomes clear that this is not just about accumulation, but about control of liquidity under increasingly refined conditions. When supply is gradually removed from active circulation, the visible market may appear calm, but underneath, the foundation is continuously shifting. One of the most important dynamics to understand here is how liquidity actually functions in crypto markets. Price does not move simply because people buy or sell. It moves because of how much available supply exists at each level of demand. When XRP is sitting in long-term wallets that are not actively traded, that portion of supply effectively becomes inactive from a market perspective. Even though it still exists, it is no longer contributing to immediate liquidity. This creates a situation where the available market is smaller than the total market, and that distinction becomes critical when demand eventually increases. What makes XRP's current structure particularly interesting is that this reduction in active supply is happening during a period where attention is not at its peak. In many historical market cycles, the most aggressive accumulation phases occur during times of low excitement, not high hype. This is because experienced participants understand a key principle. It is easier to build positions when volatility is low and attention is scattered. Once attention returns, prices often adjust quickly because the system is no longer as liquid as it appears on the surface. Another layer forming within this structure is the behavior of mid-tier holders, those who are not the largest entities but still hold significant amounts of XRP. This group often acts as a bridge between retail sentiment and institutional positioning. When this group begins to shift from active trading to holding behavior, it reinforces the overall tightening effect on circulating supply. Over time, these smaller behavioral changes compound into a larger structural shift that becomes visible only when viewed in aggregate. At the same time, market psychology plays a major role in how this phase is interpreted. Many participants misread quiet accumulation phases as lack of interest or weakness. In reality, these are often the periods where the most strategic positioning takes place. The absence of dramatic price movement does not mean inactivity. It often means that the market is absorbing supply without triggering major volatility. This is one of the most misunderstood aspects of crypto cycles, where silence is frequently mistaken for stagnation. XRP also continues to sit in a unique position due to its broader financial narrative. As global discussions around digital settlement systems, liquidity efficiency, and cross-border value transfer evolve, assets with established infrastructure narratives tend to attract longer-term attention from larger capital pools. This does not guarantee immediate price impact, but it does influence how supply is treated by those with long-range strategies. When assets are perceived as infrastructure rather than speculation, holding behavior tends to strengthen. The concept of the new 1% therefore becomes more defined in this phase. It is not just about accumulation size, but about behavioral alignment. These are holders who are not reacting to short-term volatility, but are instead positioning around long-term structural expectations. Their presence effectively reduces the sensitivity of circulating supply to market noise while increasing the potential impact of future demand shifts. As this phase continues, the market begins to resemble a compressed system where energy is stored rather than released. The longer this compression persists, the more significant the eventual release can become, depending on what triggers it. Whether that trigger is institutional demand, regulatory clarity, or macro liquidity expansion, the underlying structure is already being shaped in advance. Everything comes down to structure, timing, and the way markets eventually resolve long periods of silent compression. What has been building in the background is not a random sequence of events, but a gradual reshaping of who holds supply, how liquid that supply actually is, and what happens when demand eventually returns to a system that is quietly tightened over time. When you step back and look at the broader picture, XRP is not just moving through another market cycle. It is sitting inside a phase where ownership distribution is becoming increasingly important. The new 1% is not a fixed group or a publicly visible club. It is a behavioral category defined by patience, conviction, and low turnover. These holders do not react to noise. They accumulate during uncertainty, hold through silence, and position themselves around long-term expectations rather than short-term price action. Over time, this kind of behavior reshapes the structure of available supply in ways that are not immediately obvious on a chart. This is where the true significance of reduced exchange liquidity becomes important. When fewer tokens are available for immediate trading, the market becomes more sensitive to changes in demand. That does not mean price will move in a straight line upward. It means that any shift in demand, whether small or large, has a stronger impact than it would in a highly liquid environment. This is one of the core mechanics behind sharp expansions in crypto markets, where long periods of calm are followed by rapid repricing when conditions align. At the same time, it is important to recognize that no accumulation phase lasts forever. Markets are constantly cycling between compression and expansion, between periods of low attention and periods of high volatility. XRP's current structure suggests it is still within a phase of internal buildup where supply is being redistributed into stronger hands while broader attention remains relatively neutral. These are often the conditions that precede major directional moves, but timing remains uncertain and dependent on external catalysts. Another important layer is the psychological divide between different types of market participants. Short-term traders often interpret sideways or quiet markets as lack of opportunity, while long-term holders view the same conditions as strategic accumulation zones. This difference in perception is what allows structural shifts to happen without immediate disruption. The market effectively reorganizes itself while most participants are focused elsewhere. However, it must be clearly understood that none of this guarantees future performance. Even strong structural setups can take time to resolve, and markets can remain in compression longer than expected. External factors such as global liquidity conditions, regulatory developments, and broader crypto market cycles can all influence how and when any potential expansion phase begins. There are no certainties, only probabilities shaped by behavior and structure. So when we talk about the new 1% of XRP, we are really talking about a gradual evolution in how supply is held and how patient capital positions itself within a changing financial landscape. It represents a shift from reactive trading to long horizon positioning, from scattered ownership to more concentrated conviction-based holding patterns. The most important thing to understand is simple. Markets do not stay compressed forever. They expand when conditions align, and when they do, the impact is always shaped by what was quietly built during the silence that came before it. This content is for educational and informational purposes only and does not constitute financial, investment, or trading advice. Cryptocurrency markets are highly volatile and involve significant risk. Always do your own research and consult a licensed financial advisor before making any investment decisions.